Hello everyone, I welcome you to InSync with BDO India, where we discuss current financial reporting hot topics. Today, we welcome Swapnil Kale, partner and leader, financial services, audit and assurance, MSKA and associates. Swapnil will take us through RBI's proposal to transition from a rule-based model to a risk-based model for provisioning of loans and advances provided by banks. Over to you, Swapnil, for your deliberation.
Thank you and welcome everyone to today's InSync. We are going to cover our view on the Reserve Bank of India Scheduled Commercial Banks Asset Classification and Income Recognition Directions 2025 draft for comments. As part of the statement on development and regulatory policies, which was released on 30th September 2022, the RBI had proposed to adopt the expected credit loss based approach for loan allowances, which are required to be maintained by the bank in respect of their loan portfolio. Accordingly, the RBI has released the discussion paper in 2023 for comments. 2025 directions have been formulated, taking into account the feedback received on the earlier discussion paper issued on ECL in 2023 and on the recommendations of the external working group constituted for this purpose. These directions subsume the relevant extant provisions and are now being placed in the public domain for wider consultations. So we are going to discuss various conditions to categorize an asset as non-performing assets and further classification of non-performing assets, NPAs. Expected credit loss based provisioning. This is an important topic we are going to cover today. The conditions for income recognitions, various disclosures, and what could be the potential impact on the banks if they implement the 2025 RBI IRAC directions. Banks in India are presently operating under the income recognition, asset classification, and provisioning, which we know as IRAC norms, which have been prescribed by the RBI in line with global developments and with a view to strengthen the resilience and transparency of the banking sector. The RBI has decided to revise the extant framework comprehensively. Accordingly, the draft Reserve Bank of India IRAC 2025 directions have been issued. Principally, the overdue aging based classification, which is currently applicable, like more than 90 days non-performing assets, then certain conditions are met. The assets are further classified as substandard assets, doubtful assets, and so on, will get replaced with a more forward-looking approach, considering the risk-based models and staging approaches for the financial assets. So stage 1, low risk. Stage 2, significant increase in credit risk, which we know as SICR, and stage 3, credit impaired. The proposed expected credit loss framework would shift the banks from the traditional incurred loss approach to more predictive framework, and we believe this is a step towards the INDES implementations. Banks must now estimate losses based on probability of default, PD, a loss given default LGD, and exposure at default EAD. This allows early recognition of credit deterioration, improving the risk visibility and enabling proactive portfolio management. These directions are expected to further strengthen the credit risk management practices of the bank, promote greater comparability across the financial institutions, and align the regulatory norms with nationally accepted accounting principles or reporting norms like IFRS 9 or INDES 109, which have been made applicable to the non-banking finance companies. In terms of the applicability, currently these directions have been made applicable to scheduled commercial banks, but that does not include the RRBs, the SFBs, and payment banks. These directions will come in force from 1st April 2027. So from now till 27, bank has got some time to prepare for the implementation. There are total 6 chapters in these directions, and there are various definitions have been included. So some definitions from the earlier IRAC norms have been included. And since the banks are moving to more forward-looking approach and going to make provision based on expected credit loss, the definitions as given in Ind AS 109 have also been included in this directions. Now let's look at briefly the chapter 2, which is on the non-performing asset. A financial asset is classified as non-performing if certain conditions are met. These conditions are similar to the previous IRAC direction, so no change. However, some clarification with respect to credit card. A credit card account where the minimum amount due is not paid within 90 days from the payment due date is classified as non-performing asset. Previously, the minimum amount due or total amount due was not clearly mentioned in the IRAC direction. Now it has been clarified. Further requirement with respect to credit card, bank shall report a credit card account as past due to credit information companies or levy penal charges, that is late payment charges, etc., only when the credit card account remains past due for more than 3 days. The number of past dues and late payment charges shall, however, be from the payment due date mentioned in the credit card statement. There are certain conditions mentioned about corporate credit card. With respect to upgradation of financial assets, classified as NPA may be upgraded as standard assets only if all the dues like principal, interest are paid by the borrower. In case borrowers are having more than one loan facility, then payment of interest and principal shall be paid for all those loans to get classified from NPA to standard assets. For the purpose of these directions, the borrower and the co-borrower shall be treated jointly and severally liable for repayment of credit facility. Further classification of non-performing assets. Classification criteria is similar to previous IRAC directions. Financial assets to be further classified as substandard assets. The assets which remained NPA for a period less than or equal to 12 months, doubtful assets, an asset which remained in the substandard category for a period of 12 months, and loss assets where the auditors, external or internal, or by the RBI inspection, it is identified that an asset is a loss asset, it should be fully provided. For special cases, for non-performing assets, we have done the comparison with the current IRAC norms vis-a-vis the IRAC norms which would be made applicable from 1/4/27. We haven't identified any significant changes. For example, a term loan, bill discounted, overdraft, cash credit with stock statement, liquidity facility, in securitization, derivatives receivable, MTM exposures, no significant changes. We mentioned about credit card where a minimum amount due is explicitly mentioned in the direction. Previously, there was no clarity whether past due is with respect to minimum amount due or total amount due. In case of agricultural advances, again, no change. Agricultural loans continue to use season-based definition instead of 90 days DPD. The directions provides for explicit coverage and limits, harmonizing it with the priority sector lending. Provision for natural calamity can remain the same. In case of upgradation of NPA to standard, again, no change. However, the directions explicitly now mentions about borrower and co-borrowers are jointly and severally responsible. Further, in case of co-lending arrangement, the proposed directions have strengthened its requirement. Derivatives contract, same principles. No change in case advance against consortium, advance against term deposit, loans with moratorium on interest and export project finance. Now let's look at chapter 3, expected credit loss, most important part of these draft directions. The draft directions seem to be in line with Ind AS 109. However, there are certain additional requirements which are not there in 109. So let's look at one by one. Loans, debt instruments, trade receivables, lease receivables, loan commitments, off-balance sheet credit exposures, and any other financial asset having contractual right to receive cash are covered as financial assets and will attract and to be tested for expected credit loss based provisioning. Determining ECL requires a bank to make an assessment at each reporting date if the credit risk on a financial instrument has increased significantly since initial recognition. If that is the case, bank is required to make loan loss allowances estimated based on lifetime expected credit losses. There are many approaches for calculation of expected credit loss. However, this direction mentioned bank to use general approach consisting of three key functions. That is probability of default, PD, loss given default, LGD, and exposure at default, EAD. In terms of initial recognition, again, similar to 109, loans are required to be measured at fair value minus any transaction cost and subsequently at amortized cost. Significant increase in credit risk, the directions require bank to adopt a three-stage approach based on credit quality of the financial instrument at the time of initial recognition or any subsequent reporting date. Three-stage approach. So stage one, where financial instrument, is said to be under stage one when it has not had any significant increase in credit risk since initial recognition or has low credit risk as determined in terms of these directions. And for this stage one of instruments, 12 months ECL required to be recognized. Stage two, where a financial instrument has had a significant increase in credit risk since initial recognition, but it is not credit impaired. For such instrument, lifetime ECL should be recognized. And stage three, where financial assets have had credit impaired at reporting date. Again, lifetime ECL is required to be considered. The criteria for determining significant increase in credit risk shall be documented as clearly mentioned in the directions. At each reporting date, banks are required to assess whether credit risk on any financial instrument has increased significantly since initial recognition. There are certain exclusions. Again, these are not explicitly mentioned in Index 109, but certain instruments are not required to be tested for ECL, and as expected, SLR investments, direct claims on central government, and exposures guaranteed by central government with certain conditions. Again, another requirement which is not in Index 109 for stage 3 instruments where exposures are beyond 5 CR, the collateral charge in favor of the banks are required to be valued compulsorily once upon classification and thereafter every 2 years or lesser by the valuer appointed as per the bank's internal policy. Governance framework, very important part of these directions, and RBI is very clear, putting all kind of responsibility on the board. The governance framework requires the credit policy of the bank shall cover all aspects relating to ECL life cycle. Bank's board of directors are responsible for implementation and functioning of the expected credit loss framework on ongoing basis. A subcommittee is required to be formed of the board, which should consist of chief financial officer, chief risk officer, and they are responsible to monitor the effectiveness of bank's internal control and ensure robust implementation of approach towards the expected credit loss. Focus areas of these subcommittees have also been elaborated. Now let's look at the credit risk drivers. The directions require banks to have a sound credit risk assessment and measurement process. The same systems which have been used by the bank or the tools data which have been used by the bank to assess credit risk on the financial assets are required to provide the inputs for the computation of the expected credit loss. On forward-looking information, the directions require banks to use factors that are specific to the borrowers and assessment of both current as well as the forecast variables or microeconomic variables at each reporting date for assessment. Bank may rely on the internal projections as well based on the available information. On the effective interest rate computation, the guidelines require determination of expected interest rate on financial assets should include all payments made or received under the loan agreement between the parties of the contract, and shall also include fees, commission, besides the loan disbursal, interest payments, etc. ECL on guarantee contracts or loan commitment for which ER cannot be determined are required to be discounted by applying the appropriate discount rate that reflects the current market assessment of the time value of money. Now moving on to other prudential norms for ECL framework. The directions clearly state that the ECL allowances for stage 2 and stage 3 financial assets are required to be considered as specific provisions. Bank may consider a stage 1 ECL provision as general provision, and that can be included in tier 2 capital up to the extent prescribed limits. Currently, NBFCs are taking benefit of this. They are including stage 1 provision as part of tier 2 capital. Upgradation upgradation from stage 3 to stage 2 or stage 1. For restructured accounts, upgradation from stage 3 to stage 1 can be made as per applicable provisions of under the extant prudential framework of resolution of stressed asset, which was issued in 2019. An instrument in stage 3 can be brought to stage 2 after all irregularities due to which it was earlier classified under stage 3 are rectified. Bank shall keep such stage 3 instrument in stage 2 for a minimum period of 6 months after all irregularities are rectified before the same can be brought to stage 1. So there is a cooling off period required. Financial instruments cannot be or required to remain in stage 2 for a period of 6 months. Banks need to monitor them for 6 months, and if all irregularities are rectified, they can be moved to stage 1. For a restructured financial instrument which has satisfactorily completed its monitoring period, they can directly go to stage 1. Now moving on to prudential floor. This is very specific to these directions. It is not in Index 109. The direction states the ECL estimates arrived by the bank at stage 1, 2, 3 shall be subject to the product-wise prudential floor as a regulatory backstop. So RBI has prescribed a minimum requirement for arriving at stage 1, 2, 3 ECL estimates, and which will be minimum, as per the guidelines. Moving on to the regulatory probability of default. The 12 months probability of default for any instrument that comes under the purview of ECL shall not be less than 0.05%. A regulatory loss given default for LGD computation, which is based on the historical information and future microeconomic projections. However, if the bank finds itself unable to correctly estimate the LGD, it may take resort to the regulatory backstop. So for secured portion, the LGD can be 65%, and for unsecured portion, the LGD can be 70%. In case of specific cases, the provisioning requirement shall also be additionally subject to other relevant directions issued by RBI from time to time, like for stressed asset, unhedged foreign currency exposures, country risk, fraud where 100% provision is required after adjusting the collateral, restructured assets, and willful defaulters. So additional provision is required to be made in these cases. Now coming to the transitional arrangement, one of the important aspect of this 2025 direction, the Reserve Bank of India has decided to include or introduce a transitional arrangement whereby a time has been given to the banks to rebuild the capital. The transitional arrangement it's an adjustment amount, that is the difference between the ECL required as on 1st of April 2027, which is computed based on the balance sheet provision as on March 31, 2027. And the provision that was already created in the books as per the extant IRAC norms, which are currently in force as at March 27. The difference can be, if the bank want, be added to the common equity tier, that is CET1 capital. This benefit is available up to March 2031. The table gives the amount that can be added back to the tier 1 capital every year. For example, in 2027-28, the maximum transitional amount is 4/5, and then 3/5, 2/5, and 1/5 till 2030-31. This is the adjustment in tier 1 capital. There is no mention about how this amount will be disclosed or adjusted in the financial statements. However, the directions requires appropriate disclosures to be made in the financial statement regarding the transitional adjustment. We have done high-level comparison between the 2025 directions and the and Ind AS 109, which covers expected credit loss based provisioning. We noted certain specific mention which are there in the draft directions issued by RBI, but not there in Ind AS 109. For example, certain instruments not to be tested for SICR, or bank is not required to maintain stage 1 ECL provision on certain instruments, like exposures guaranteed by central government and so on. There's no mention in Ind AS 109. Collateral in respect of stage 3 having exposure of more than 5 CR not required to or required to be valued compulsorily, specifically mentioned in the direction, but not in Ind AS 109. There is no requirement of prudential floors or regulatory PD or LGD, which is mentioned, Ind AS 109, but the draft direction requires to have minimum prudential floors or minimum regulatory PD or regulatory LGD. Additional requirement in specific cases clearly stated in draft directions, but not in Ind AS 109. The important aspect which we kind of spoke about in the previous slide about transitional arrangement, RBI is giving time to banks to rebuild their capital and allowing certain adjustment in tier 1 capital, but no such requirement in Ind AS 109. Again, last but not the least, credit conversion factors specifically mentioned in the annexure of RBI direction, but there is no such mention in Ind AS 109. So we discussed chapter 3 expected credit loss. Now let's look at chapter 4 income recognition under the draft directions for IRAC 2025 issued by the RBI. For stage 1 and 2 interest income on financial assets such as loans should be calculated using the effective interest rate. And that rate shall be applied to the gross carrying amount of the financial asset. This is for stage 1 and stage 2. For stage 3, the conditions are slightly different. So the financial assets which have been classified as stage 3 and which are not POCI but subsequently became credit impaired or considered as default assets, the effective interest rate, which should be the original effective interest rate, should be applied to the amortized cost of the financial asset in subsequent reporting period from the date they became credit impaired, that is being classified as stage 3 assets. These conditions, there are certain conditions in para 82, 83, which are kind of covered for effective interest rate. For stage 3 effective interest rate, the directions require the amount of interest revenue which have been accrued on the financial assets on stage 3 assets should be debited to profit and loss as an additional ECL provision. Further, the bank may transfer the amount to a specific loan loss account to track the outstanding dues. So these are the conditions for income recognition. Stage 1 and 2 slightly different conditions, and stage 3 different conditions. Now let's look at next chapter, chapter 5, principles of risk management. The directions clearly state in order to achieve the accurate, transparent and compliant ECL computation, banks are required to adhere or ensure a set of principles governing the model selections, management validation, monitoring and governance. The directions provide various principles to achieve the above objective. Chapter 6, disclosures. Detailed disclosures are required to be given in the financial statement, which are clearly stated in Annexure 4 of the draft directions, and also it prescribes the illustrative list of disclosures. Banks are required to give detailed disclosure in the notes to the accounts of financial notes to the accounts to the financial statements of all financial assets which come under the purview of these directions. The credit risk disclosures made by the bank shall enable the users of financial statements to understand the effects of credit risk, of the amount, timing, and uncertainty of future cash flows. So now we move to the conclusion of today's InSync. ECL implementation for the bank has been in discussion for quite some time. In fact, for quite many years, RBI has been taking baby steps to ensure that banks also move to a full Ind-AS implementation. RBI has already issued directions on ESOP, which are required to be fair valued. RBI revised the directions on investments. Last year, in 2023, the discussion paper on ECL was issued for comments. So based on the comments received on that discussion paper and based on the committee which was responsible for implementation of ECL for banks, RBI issued the draft directions 2025 on ECL. We believe that post these directions become effective, from 1/4/27, the banks will move to full Ind-AS implementation. In our view, these draft directions will have some impact on Indian banking system. The implementation of ECL framework will strengthen the bank's resilience by shifting from incurred loss model to more forward-looking approach to credit risk. It will improve the asset quality monitoring, and more importantly, the comparability with global financial institution by aligning itself to global standards like IFRS 9. While it will require higher provision, but it will cause a modest and phased impact on capital and profitability. The overall effect is expected to be manageable due to the existing capital buffers and the phased implementation over 4 years, and the other reforms which RBI has been taking. Since the banks will move from incurred loss to expected credit loss, we expect higher provision in the initial year, especially for stage 2 assets, where the credit risk has increased significantly but not impaired. Some estimates suggest that there could be impact of 60,000 crore on the overall banking system in India. The cascading effect of higher provision will impact the profitability. However, the RBI expects overall impact to be minimal by allowing the bank to make a transitional adjustment to tier 1 capital. So RBI has given a glide path that will help to spread the impact of ECL for over several years. There is also going to be a variable impact. We in our view, large banks will have minimum impact, whereas the medium and small size banks will have higher impact because of implementation of the ECL. On the positive side, we believe the aligning with global standards like IFRS 9 will help Indian banks to compare itself with global financial institutions, and it will also improve the asset quality monitoring. With this, we end today's InSync. Thank you for patient listening.